why we're getting together and why I started these meetups. So we've been doing these meetups for a year now. So I started this LinkedIn financial modelling and Excel group, and it got very popular. We've got nearly 40,000 people all over the world that write in and put discussions about Excel and financial modelling. And I just really feel quite strongly that people spend too much time online nowadays. We're always, as modellers, we're spending so much time on a screen, behind our computers, talking to our Excel formulas. And I think it's important that we sometimes get out from behind our desks and talk to each other and talk to other people and get together and find out, new things that are going on, find out what other people are doing. And so that's the purpose of these meetup groups. So I'm based in Sydney. I run these meetup groups in Sydney, Melbourne and Brisbane, and we've got one in Perth as well, so I'll be over in Perth in a couple of weeks. Because I'm based in Sydney, we run the Sydney one quite regularly, so because I know lots of people in Sydney that I can invite to these speakers, so watch out, you might be next. So I like to sort of hear from different people about different aspects of modelling. We've got pure financial modellers, we've got a banker tonight, we've got an M&A guy coming up soon. We've got lots of different types of people who can give us their perspective on using Excel for the purpose of modelling and financial analysis. So I'm just going to introduce Matt Costello. So we're really lucky to have him here tonight. He's going to tell us all about his experience as a banker. He says that he's seen lots and lots of financial models. There's so many different things that people do that don't make his job very easy. So he's going to tell us about it. I've known that for quite a long time. We met as part of doing, when I did my MBA at MGSM, so we met through that. So join me in welcoming Matt Costello.
Thank you. So I've got a presentation. It's more a bunch of pointers for me, but there's a couple of pretty pictures. What I really, a quick introduction for me. I'm not really a banker by trade. I didn't start out as a banker, but I did started a business as a mobile marketing company quite a while ago. I sold it to 9MSN. We started again in the US and I sold it over there as well. I came back and I did some strategy work, and I was CFO of a public company. I did a big IT roll-up with some investors. I worked in sort of private equity, and then I did a couple of years in investment banking, so I bought some businesses on behalf of other people, so we did a lot of work there, so I've done a lot of M&A. And now had my own consultancy, which was based around strategy and basically preparing a business for sale over a long period of time. I've basically found that investment banking, that when you kind of found a business that wanted to sell, sometimes it was a little bit too late. We weren't able to maximise the value, so I started a consultancy. We worked with a company for 1 or 2 years, making sure all the metrics were right in the business and the business was prepared to sell. It was called Fit for Sale, actually. It was a working title. We couldn't think of anything better, so we just called it Fit for Sale. So it was a kind of boot camp. I also do some regular speaking, so I work with AMI, the Australian Digital Media Association, and I do an MBA a day course, really. What it is about business fundamentals for people who aren't really generally financial gurus or anything. And now I'm managing director for a small boutique supply chain finance bank out of the UK called Greensill Capital, so I'm in the Asia Pac territory for them. As part of that role, I see a lot of financial models. We're a very small team, so I do a lot of credit analysis myself. But I do a lot of work with balance sheets. I do a lot of work with financial models. Modelers send me their stuff all the time, and I look at it and weep and think, wow, I spent so much time on this. But there are some great skills out there, and there's some great models, and obviously Excel is a really powerful tool. So I'm not really going to get into that per se. What I'm mostly going to talk about is what we want out of that, and also how we kind of look at balance sheet and how we sort of treat some of those models and projections, and stress test a model and those sort of things to give us the sort of numbers that we need in order to make credit decisions. So the kind of clients we work with, supply chain finance is really quite new in the Australian market in the way that we're doing it. basically, we were founded 4 years ago, so we're kind of a fintech startup, really. But all ex-City bankers and JP Morgan bankers that sort of founded supply chain, the concept of supply chain finance. In a nutshell, what we do is we buy receivables from small suppliers, confirmed by big buyers. And so what you've got is you've got really big buyers. So one of our clients is Vodafone, for example. Vodafone globally, we run their supply chain finance. It's one of the biggest in the world. Got about building up to about $7 billion in assets in that supply chain finance program at the moment. But what happens is that Vodafone, big ugly beast that it is, it turns around to its customers and said, well, you know how you sell to us, we're going to pay you in 120 days. And they go, what? We can't afford that. And they go, well, okay, well, if you want a solution, we can organise something. So Greensill comes along and we buy the receivables from the suppliers at Vodafone's cost of capital. So if they had to go to a bank, they'd go, hi, I'm a little supplier. The bank will go, yeah, sure, I'm not going to do the money, and if I do, it's going to be 20%, whereas we can buy it on Vodafone's risk rating, much, much lower than what the supplier can. So it's kind of a win-win. Vodafone gets to pay us later, and the supplier gets their money earlier at a much lower cost. And when you think about it, whenever a big company makes their customers wait, makes their suppliers wait for their money, effectively they're importing their smaller customers' cost of capital, and which is very inefficient from a kind of supply chain and capital management perspective. So supply chain finance is very much about putting the capital into that supply chain at the right kind of cost, and that is obviously the big buyer's cost. So some of what I'm going to talk to relates to the sort of metrics that I as a banker want to see to lend on. How do I assess risk? How do I use a model? How do I take projections? How do I stress test a model, etc. Some of it's about how we treat a balance sheet. So I've got a bit of info here about playing around with a balance sheet. I've even got what else have I got in there? Some ratios. Love ratios. Okay, so modelers don't often deal with ratios. They provide all of the inputs that then generate the ratios that I need to look at. So we do a lot of the ratios ourselves, but we can also get some big data sources that tell us those ratios. And it's funny how many different ways there are to calculate some ratios, so they can look different. So we try to kind of aim for consistency across the various data sources that we get, so that we can compare ratios on a like-for-like basis. And a little bit about the ratios that an M&A professional might look for and an equity investor might look for, because they're all quite different. And then just a bit more about the wrappies. So I think I'm going to be about 15-20 minutes. They're just guide slides, so please put up your hand and yell out and ask questions if you have any. But I thought I'd kind of start with the birth of the model. And I've actually got a balance sheet that results from this, and we can talk through that balance sheet because there's some interesting sort of conversations we can have about how you treat this idea. But I'll just read through it. This is the only thing I'm going to read. So you've got a great idea, and you've got $1 million spare, I wish, and you want to put it into a new business. You spend 6 months developing the software, to develop a new manufacturing process to create your great new widget, and then you go to market and you generate some great sales. So a great result. This would be an ideal startup. You order all the components for the widgets up front because you can get a good deal, and in the first 12 months you start to get some interest for some M&A buyers. Now that story can turn into a balance sheet, and I can show you that balance sheet. And for those of you that are quite experienced modelers or bankers, you can start to picture, well, okay, I can see cash there. I can see some of that cash goes to equity, and some of that cash goes maybe to debt. I'll explain why to go to debt. You can see some inventory, you can see some property, plant and equipment, and maybe if you're really kind of on the ball, you can see that some of those expenses in the first 6 months, instead of going onto the P&L, could go on the balance sheet as intangibles. So they're the sorts of decisions and sort of views of a balance sheet and the metrics and the model that start to form out of a story that somebody might tell you. So unfortunately, when someone tells me a story like that, I start to see the numbers that come out the back end. And actually, I'll just flip over to the spreadsheet that kind of can pop out from that. 12 months later, you're sitting down with your accountant, and you kind of turn around and you look at this, and you see $3 million in revenue. You've got COGS of $750. That's the inventory I had to buy. You've got expenses of $1 million. And here's where so, as a banker, what we come to look at something like that, and we say, well, shareholder debt, as if we're going to treat that as equity. Intangible assets, well, I'm not going to get any resale out of that, so I think I'm going to ignore that as well. So we can start to have a look at some of the accounting decisions that are made for a good result for the owner of that business, and then some of the banking decisions that the way we might treat that balance sheet, and the differences between how I view that as a risky balance sheet versus how the owner sees it as a good saleable balance sheet. So there's a story, there's a balance sheet as a result. Does that kind of resonate with anybody? Has anybody had to deal with this sort of notion of, this story about a business? Everything sort of has this narrative around it, and then you look at the balance sheet and okay, well, how do those two things match? Yeah, great. Okay. So this is the sort of thing that we deal with every day. We sit down with owners of businesses, they tell us the story about the business, and then we have to decide whether we're going to invest in that. And it's debt we lend, but it's certainly an investment. We lend to that business based on that story and based on the balance sheet that results from that story. So, capital. We deal with capital, we deal with equity, we deal with debt, and effectively that's capital. And this is, you all know that assets equals liabilities, and assets equals liabilities plus equity. And what's really interesting when we lend often is that this concept of owner's equity and off-balance sheet liabilities and off-balance sheet assets. And when we're lending, we often have a look at and we say, well, what else is available, or what else is kind of putting that balance sheet at risk that isn't necessarily on the balance sheet? And certainly when you're lending, particularly a small business, the first thing for any Australian bank particularly, who are the biggest, laziest bunch of banks you've ever seen in the world. Here's an interesting stat for you. Basically, in Australia, 80% of all business lending is done by the big four banks. In the US, that same figure is 16%. And that is because there are so many alternative lenders in the US market, and in the European market, the same figure is around 20%. So there's a massive sort of disconnect. Here the Australian banks are very, very conservative in lending practices. And when I'm talking about off-balance sheet lending, you certainly have off-balance sheet liabilities, but you've got off-balance sheet assets, particularly when you turn to the owners and say, do you have a house? And they go, yep. Do you have a mortgage? No, I've paid it off. Great. How about, instead of worrying about all of the details of your business, you just give me a mortgage on your bank, I'll give you $1 million and you can use that $1 million in your mortgage, but it's secured against your house. That's most of what bank lending to businesses is, particularly below a certain level in the Australian market. And it's unfortunate, but that's the results of a first world economy with a very, very small kind of market to lend into. So on balance sheet and off balance sheet kind of considerations come in to this sort of lending, but it's a lot of fun. So basically, in the hands of a buyer, the tax rate may be different for different reasons or in different jurisdictions, etc. So, EBITDA is a really good proxy for cash flow. It's still important from our perspective to go and do free cash flow models. Interest coverage is a big one, so what's the multiple on interest to EBITDA to make sure that you're not charging so much interest that all the profit's going to disappear. Debt to equity is an obvious one. Free cash flow. I'm trying to remember, because I can't off the top of my head, capital asset pricing or CAPM models definitely have some really good free cash flow component, free cash flow to firm, free cash flow to equity, and certainly where you use things like return on assets, return on equity, and DIO, DPO, DSO to drive the model in those CAPM forward-looking models, because you're using forward projections to basically arrive at a capital asset pricing model as a stock price, effectively.
What do you look for in interest coverage, the ratio,
Anything less than 1, depending on the risk of the business. So as soon as 50%,
20%, 2-3 times interest. We more look at EBITDA to debt and keep an eye on interest coverage. So EBITDA to debt multiples. So in terms of credit risk, a B would be sort of 3 or 4 times. So debt is 3 or 4 times EBITDA, and that would be a kind of a double B business, just as looking at that ratio alone. A single B would be sort of 4, 5, 6, and sort of you really start to get into some very risky lending when you're looking at EBITDA to ratios, EBITDA to debt of 6, 7, 8, 9 times. However, what you really need to do is make sure you also check what assets they're lending against. So you can see some businesses. So I had a look at a mining services business. They rented big yellow equipment to miners. They had 20 million EBITDA, $150 million in debt. That's a massive debt to EBITDA ratio. However, they had $200 million worth of yellow equipment. So, and most of the debt was secured against the yellow equipment. So you kind of almost take that out of the equation. So there's plenty of capacity in the business to service that. The interest, the financing costs will sort of embed in the business expense go leased equipment, lease hire sort of equipment. So interest coverage there though is still under 1, which is important. However, EBITDA to equity is really high. EBITDA to debt is really high. Any questions on that? So in M&A activities, some of the kind of things that we're looking at, EBITDA multiples. EBITDA multiples, so 5 times EBITDA is what the valuation is of a company. Has anyone heard those sort of terms before? It's a really common shorthand way to basically value an IT services business might be 3 to 5 times EBITDA in terms of valuation. A successful sort of business, consumer internet firm might be 100 times EBITDA in terms of valuation. What's really important to always understand, particularly from our perspective or even from an M&A professional's perspective, is that they're only a shorthand for DCF calculations. EBITDA multiples are just a shorthand way to compare similar businesses in an industry. They're not a way to value it. The only way to value a business is with a DCF. There are other things, and the difference in EBITDA multiples between one business and the next is a result of the DCF calculations coming out with a different result. And so, 5 million EBITDA, 4 times EBITDA gives you $20 million valuation for one business, same business, and that might have high level of IP, very secure contracts, etc. So they get 5 times. Similar business that's got no secure contracts, same EBITDA number, not a lot of IP, they're just straight sort of headcount shot, and that business might get 3 times EBITDA or even 2 times EBITDA. So that valuation doesn't mean both of them need to be 5 times. They're obviously very different businesses from an underlying sustainable earnings perspective, so therefore the EBITDA multiples are really different. What's really important though is that when we model those sort of numbers, when you provide us models, we want to be able to easily reconcile free cash flow to your cash flow statements. We want to be able to easily reconcile it to your profit and loss performance, and we want to see the movements, so your working capital movements between your days payable and your receivables, etc. So as we can really understand the dynamics and CapEx, because that obviously kind of figures into that free cash flow. And sometimes they get hidden in these rolled up accounts, and you've just got to tease them apart. It's a little bit tedious trying to discover some of these things in the models. We can argue this one till we're blue in the face, but payback period, I feel, for a business that ends up embedded and fully integrated into your company, you need to understand what your payback period of an acquisition is. Because what you'll do, so the theory is that you pay a discounted cash flow if the business is going to generate cash indefinitely into the future. You integrate it into your company, the people disperse, the IP, the customers, it's all embedded in there. So if you're going to pay $5 million for a business, you want to know that you're going to get that $5 million back, because it gets subsumed into the company. It doesn't become a cash generating unit. It's hard to identify in terms of ongoing valuation, so you've got to do the impairment test for any goodwill that you end up on your books each year. It's hard to identify the cash flows, so I think the payback period on an acquisition can really be important as well. And then, as an acquisition, you also want to know if you'd spend $5 million, what's your return on those assets going to be, as an ROA and an ROE perspective. And sustainable growth rate, that's a nice one. That's more about capacity. It's not a valuation metric by any stretch, but it's about the efficiency of the business. And a good SGR score is nice, but it doesn't generally determine anything. It's good to understand that. And from an equity perspective, I think some of the ratios we're really kind of interested in understanding, particularly if it's an early startup, is your cost of customer acquisition. So a lot of startups have come to me in the past and say, we're going to do $100 million in the next 12 months. If we get $20 million in equity today, it's like, well, okay, if you don't get $20 million today, what are you going to do in 12 months? Because I don't have any equity, I don't have any money to spend. So what's really important is that you understand, if you were given $5 million or $10 million or $15 million, how do you turn that into customers, and how do you turn that into revenue generation? And the idea of a cost per customer acquisition, particularly in consumer-facing businesses, becomes really critical. And how much is that customer worth to you over time? So customer lifetime value is a complementary kind of metrics to that. And I've seen some fantastic models, particularly out of the digital space, that analyse the hell out of this customer, particularly direct response businesses. And some of the most sophisticated models that I've seen come out of direct response businesses, where they know exactly what to spend on advertising, they know what the take-up rate for that is going to be, and they know what the customer lifetime value is. And so they know that if they ramp up advertising, they pull in some equity and they spend $10 million in advertising instead of the current $5 million, this is exactly what will happen to their customer numbers. They're going to have customer retention, customer churn, customer lifetime value. All of those things are really critical numbers in those sort of digital consumer-facing businesses. In fact, more broadly in any sort of FMCG, those customer numbers as well. Does anyone drive any models off the kind of customer lifetime, customer acquisition? They're really interesting models. Have you dealt much, Daniel, with those?
Yeah, a little bit.
Yeah. They're fascinating to see the churn rates and the value. And there really is a value as well, because you can look at, you basically value those businesses off the lifetime customer value. You look at the customer count.
And if you've got good historical data, you know what the churn is. Otherwise, it's quite hard to model, because you just don't really know if it's a new product. You just don't really know.
Yeah, for a brand new startup it is. But that's where you get this kind of testing, this kind of testing hypothesis. So the lean methodology, where you might go out to market with a minimal viable product, an MVP, test it in the market, see what kind of traction you get, and start to model up your cost of customer acquisition sort of ideas and your take-up rates, etc.
So on this point about the cost per customer for startup or early stage company, how I understand the testing and assumption and so on, but I have meetings with investors where they always ask that question, and the guys, clearly you don't have history, you can make whatever assumption you want if you want nothing, right? So what's your, I guess, the approach in that sense? Because, I mean, even to answer the question, because you really don't know what's the answer.
Yeah, well, you've got to know what the inputs are and what you're going to go out and test. So you've got to say, well, okay, here's our product, this is where we think it fits in the market. These are our suggested advertising channels. These sort of businesses, these similar businesses advertise here, or kind of like advertising. So what we want to use some money for is to go out and test, and we're testing these assumptions. This kind of direct response, these kind of costs. And if we can get the cost of customer acquisition to this is how the business will scale. So you've got to have some hypotheses about what that might be, or at least how you might go and find it out. Because to just say, you know, if we can get our cost of customer acquisition to $2 and our customer lifetime value to $100, we can run the business like this. They're like, yeah, of course, everybody thinks that. But what are you going to test and how are you going to test it? And what are the variables that go into that? So as you can have at least an informed conversation with your investor as to how you might derive, you know, what are the drivers for your cost of customer acquisition. So, yeah, you don't know it when you're new, but you've got to have an idea as to how you're going to find it out and what sort of testing you're going to do. I'm going to put 10 grand into Google AdWords, and I'm going to run it like this, and this is what's going to happen. There's a really good business I've been working with in a lot of years, Deals I Love. They kind of started as a group buying business and just morphed into a straight ahead e-commerce business. But they do a daily email. And when Christian first came to me and said, can we raise some equity on this, he spent some of his own money on discovering, you know, I'm going to do this advertising, I'm going to put people on the street, I'm going to do these sort of 3 things and see what gives me the best return for the money down in terms of, you know, acquiring customers. And now he's got it down to a fine art. He knows that he's sending out 3 emails a day, he knows that he advertises like this, and it's quite a refined model now. But he had to go out and experiment and discover it. A lot of the incubators spend a lot of time working on those, you know, get a product into market, the MVP into market, and then test it and see what kind of uptake you get to see if you can develop a you know, customer-based modelling off the back of that. For equity investors, post-money valuations are really important as well because that determines how much of a percentage they have of the business. So if they're putting in $3 million on a $12 million post-money, they've got 25% of the business. So, so post-money value for investors, equity investors, is a key number for them. And actually, to be honest, a lot of equity investors work backwards from the percentage they want of the business rather than forwards as to what they think the business is worth. And it's really quite deceiving. I think my business is worth $10 million. It's like an equity investor is really going, well, I really like the idea, but it's quite risky, so I need 40% of the business in order to, you know, they can go through the next 3 rounds and I'll end up with 15% at the end and they'll exit like this, and that means I'm going to get my, you know, 25% per annum compound annual growth rate target. And what the dilution rate is you go through various rounds. How we go on time and questions? Good. So just on the projections, we spoke about top-down models. So the top-down model I see a lot of, which is, this is last year projections, next year we're going to do 15% better. We're going to drive our inventory from 60 days to 50 days. We're going to push out our payables from 30 days to 45 days, and we're going to bring in our receivables from 60 days to 30 days. So that's a top-down approach, kind of a target-based model. And it's kind of good, and they're great targets, but I really find that the more robust models are the bottoms-up approach, where I get a list of customers, a list of contracts, or a list of upcoming projects that they're bidding for. I've got a historical, you know, RFI process win rate. So, you know, they bid for 5 projects, they get 2 or 3 historically. So there's, you know, 10 RFIs coming out over the next 12 months. I'm gonna put them in for all. Here's my team of folks that are going to focus on that. So there's some really sophisticated bottoms-up approach on how to arrive at a revenue number. And then you can work back from there, which basically says, well, if that's my revenue target, they're the customers, here's their payment terms. You can start to forward drive that model from there. And then we test it historically, like we love projections, but if we get a projection that says 15% performance on last year, we'll probably discount it. If I get a list of customers and wins and contracts, we'll probably look at that 15%, you know, projected target in a much different way than if I didn't see that background information. So that list of, you know, project wins. And interestingly, you know, in various stages of the conversations, and again from a modelling perspective, this might be important. It's really okay to take out customer names and then drop them back in after we do the NDA and enter real due diligence. So basically being able to pull a lot of confidential information out of the model, such as names of customers, names of funders, names of key staff, all of those sort of things, and then drop them back in when we get into full due diligence. What's really important for me though is that if I see a sensitised version of it, or a redacted version of the model, when I get the populated version later on, they're actually the same model, because nothing makes us more nervous than seeing versions and versions of models and changes. And if there are changes, I want to see the changes reconciled against previous. Hey, look, the last revenue projection you saw was 100 million, but we just won this contract, so it's now 120 million, and I need these three things to go in order for there to be a difference, because there's nothing more surprising. Actually, I got a rejection from our insurer, our trade credit insurers. So basically, I got management accounts for 2015. It was let's call it a $500,000 profit. And then I got the audited account 6 months later, and there was a $1.2 million profit. So it actually did better. Instead of the owner's equity of $800,000, there's owner's equity of $1.2 million. I didn't see a reconciliation. I handed it to the insurers and they said, no, there's too much of a discrepancy between management accounts and audited accounts. The answer was simple. Auditors treated a whole bunch of things properly, according to accounting standards, that the management didn't. But in the absence of the reconciliation between the two and the explanation and the story around it, basically they had a $15 million sort of facility nearly put. We've gone back and done the reconciliation, but the reconciliation between versions is important. And stress tests. Who does stress testing on their model? Please tell me who does it. How do you do it? Has anyone found a good way to do a stress test on a? What's your favourite stress testing?
We work it back to zero. So we buy pools of debts, credit cards, unsecured debts, and so we have the stress test various collection rates and the resources that we're putting against that to actually collect. So we just run it back to zero and see where break even is. Yeah. And then once we know that, we have a safety net.
Yeah. That's that whole loss given default. You kind of start at 100% and you work your way back up. I think from our perspective, judging risk, saying that I'm going to lose all my money is not the right way to do it. And so stress testing, your break-even point, at what sort of sales can I run up until the business sort of starts losing money. That's important. So we really do want to see very worst-case scenarios. So, I start losing money at this point. This percentage either side, high, low, mid, hate it. It's just horrible. It's useless, really. It's kind of like a swag on, 5% overperformance, 5% underperformance. Probably the next best thing I'd like to see is, historically we miss budget like this. Budget's one number. I think a one number budget is, we're going to do $100,000 in March, $120,000 in April. I think that's generally garbage. You've got to have it because you've got to kind of peg it, but I kind of prefer confidence intervals. Historically in March, we performed like this. It's a volatile month for these reasons, and so then for my $100,000 March figure, it's basically got a high and a low of X and Y, and it could overperform much more than it underperformed, or it could underperform much more than it overperforms. But stress testing, where you've got a little bit of intelligence around the variability and the volatility, I think is much more valuable than just 5% up or down. When you see 5% up or down, or 10% or whatever it is, you know that there hasn't been a lot of thought put into what the volatility levels of a particular business might be, or revenue lines might be, or cost lines, etc. So if you ever have the opportunity to run some Monte Carlo simulations on your model, go for it, because I love them. But confidence intervals based on historical volatility, and it's quite a statistical sort of piece of work to get that. But it's.
Did you know that the Excel 2016 does confidence intervals really easily with the forecast sheet? So exciting.
I reckon I'm going to invent a plugin where you can just drag sliders around, and it changes projections, because you need some easy way to kind of put in this volatility in the business. And so we look at businesses that have grown, we look at the annual accounts. When you dig into the monthly accounts and you have a look at the underlying volatility of the business, you go, holy hell, what the hell? You know, this sort of 5% kind of per annum growth is achieved by, 50% down in one month and 120% up in another month. And so understanding that, particularly when you're lending in the working capital level, or when you're looking at facility sizes and facility risks and what it takes for a company to run into trouble, is a really interesting piece of analysis. So in stress testing, I'd really kind of ask you to go beyond plus, high, mid, low, and really kind of say, don't give me a number, give me a confidence interval, or give me a volatility score, because then we can really dig into that and sort of understand what the ups and downs of the business. Because we're going to do the same on the industry level, because if you say you're going to grow 15%, and I look at analysis that says the industry is going to grow at -3%, I'm asking you to explain, why are you saying 15% growth when the industry is going backwards? It's a really important question. It's got to be answered well. And it's going to be answered in combination of your bottoms-up approach, your top-down approach, your stress testing, etc. But certainly if we're doing an asset-based lend, so you've got an inventory, it's worth $40 million, we'll bring a valuer in and say, well, what's scrap worth on this steel lend particularly? What's scrap worth? What's resale worth? Who are the resale partners? What is it going to cost us to sell? How long is it going to take us to sell? So what's the recovery value? So we might lend, for example, $15 million against $40 million worth of inventory, because just of the way that we might dispose of that, so as that our loss given default is as low as possible. It might be that the worst case scenario is $10 million recovery and $40 million in revenue, so we'll go and insure the $5 million shortfall. And we'll pay a few percentage points away on that. So that's kind of on projections.
Monte Carlo, you obviously like it. Do you see many?
No, not enough at all. I don't understand why people don't put in, they kind of produce a projection, say, there you go, there's the projection. It's like, thanks, now I've got to go do all this work around industry risk, business risk, historical performance, all of those sort of things. Whereas if you kind of gave me, I think one of the difficulties with Monte Carlo is that there's so many variables in a bottoms-up model that it's really difficult to kind of plug in the variables, which can sometimes be quite simplistic. But even management and even bankers, I don't think really put much in, sort of.
They love a diagram.
Yeah.
It's Taylor's culture.
I've used Excel macros to basically simulate a Monte Carlo simulation, set up a bunch of variables, run macros to kind of put the variables between positive and negative. So, revenue, sort of underperformance, overperformance, give me a range, generate a random number between those two. Expenses, narrow range because it's more in control. Stock fluctuations, etc. 5, 6, 7 variables. And then you can actually, instead of spending all that money on Oracle's Monte Carlo simulator, you can use the random number generator, a bunch of variables, you output it into single line items, and you get a really nice scatter diagram of possible outcomes at profit level. That's a really nice way to kind of simulate Monte Carlo simulation. And I've done a few investment cases off the back of that sort of thing as well. And that little macro, I think, runs really well. You just let it run 2,000 times, for example, 10,000 times. It makes for pretty pictures too. There's some really things that you don't need to do, because if you're going to include a lot of the ratios, tell me how you arrived at the ratios, otherwise I'll just use our standard stuff to do it.
Sorry, just curiosity. Do you ever use the Altman formula, the zetas, to calculate the possible bankruptcy?
Oh, Z Altman score? Yeah, I do. Yeah, actually. And so I was just going to sort of pull up a model. So not for any particular business other than I wanted to do something for this. I got so Hills Holdings is a listed company. Oops, sorry, I hope this is. So I downloaded their Cap IQ numbers, and I've run a really rough. So someone will say, "Would you lend to us?" And I go, "Maybe. I'll get your financials and I'll have a look." And so this is our kind of sketch. So we turn the model into something basic. We do look up tables, etc. to just quick sum ifs. We categorise it, put numbers against it, and sum all of this data behind it, so income statements, balance sheet, etc.
And you're happy for us to get a copy of
Yeah, it's publicly available
send this
information,
out.
so nothing sensitive about it. Balance sheet, but then down the bottom here, once we kind of do that, is we do some free cash flow. The question is free cash flow to firm, free cash flow to equity. What are we looking at? Probably free cash flow to firm for debt lending. EBITDA ratios, interest coverage, cash conversion cycle, ROE, ROA, Z Altman score. And I'm not sure if the Z score actually tells us anything. It tells us that I've seen a lot of businesses with a really low score do really well, and vice versa. I think it's useful. It is instructive, and you can have a look at it and go, nothing to worry about. So it's kind of like the sustainable growth rate. There may be some banks, as I said, I haven't worked in a bank, and there are some scores that go, no, probability of default's way too high, I'm not going to do this. And the Z score is one of the main ones, but I think ratings are probably used more, so Moody's, Standard & Poor's and those sort of equivalents, particularly for listed companies. But very, very few Australian businesses are rated by those guys as well. So when you're looking at private companies or listed companies that are too small to be covered by ratings agencies, the Z score is instructive. Has anyone dealt with the Z score before? No?
They're not entirely useful, particularly in the small firms.
Yeah.
Because particularly if you get a small firm in the growth phase, then you can have them recognising the revenue very early on their books, and they're putting on new staff and buying new inventory. And while on the books it looks terrific and they've done well, they're actually running out of cash at a fast rate of knots, depending on what their cash conversion cycle is.
The riskiest, by far, the riskiest business is not a business that's chugging along, not doing very well. The riskiest business is a stellar performing business that is outgrowing both the owner's ability to manage it and the owner's ability to fund it. They're incredibly risky businesses because you've just got this massive working capital gap that keeps building. They lose control of inventory, they lose control. We were out at an ambulance manufacturer. They scored a contract to build 60 ambulances, and it was going to take them a year to build the 60 ambulances, and the procurement guy bought all 60 ambulances worth of components in 1 month. Madness. Everyone was really excited about the 60 ambulances, but that's no way to run a procurement department. It just smashed them from a cash perspective, and so they were in real trouble. So they won a fantastic contract. It was a business. Actually, we had a default. It's public, so I can talk about it. Carter was a mining services business in Western Australia. They had one customer, Griffin Coal Mines. Griffin Coal Mines was owned overseas, really bad payers. His business was just digging stuff up for $10 million a year, $20 million a year. Scored its contract, $100 million a year. Bought all this equipment in, couldn't collect quickly enough, went under owing its $10 million. So great story, but he just couldn't manage the growth of the business. It's very, very risky businesses, those that are not managing their cash when they're doing very, very well. Anyway, that's what I've got to say about models. Please come and ask me lots of questions. Do you have any more questions now?
Just quickly on, you mentioned about term. What would you do about choosing a term for not
Look, that's a killer. So rarely more than 12 months because they become less and less believable out more than 12 months. If you're lending for 3 years, you probably want to, but we do short tenor loans, so our maximum tenor is 180 days. We roll them, but we get principal and interest payments within 180 days. But you know, you do a cap-end model on BHP and you go 10 years out, sure, that's, you know, it's a commodity and it's a big business. But for small businesses, it's hard to really believe anything more than 12 months. And even that's pretty hard to swallow sometimes when you see historical performance of $5 million and so, but next year's going to be huge. Anyway, thank you.
Thank you.
Absolutely fascinating, really useful for me. I think you guys would have found it really relevant to your job as well. So thank you very much for such an informative. I can't believe you packed in so much in such a short space of time. No, it's great. The next one we've got coming up next month is a little bit different. It's a bit of a fluffy subject. It's emotional intelligence for financial modelling, which is something we're not always that great at. You know, all of that stuff like, you know, you've got to get your numbers across the line, you've got to present in front of people, all that sort of stuff. We've got a guy coming to talk to us about that, so I hope you'll join us for that one. I'll send the details out for that very soon, and I'll give you a copy of if you registered your details, I'll send out a copy of the presentation, as well as the models, which I think are really useful and interesting. So thank you so much, Beth. Hang around, have a drink, and have a chat. See you next time.